Okay, so today we're digging into Chalet Hotels. Specifically, their really quite explosive Q1 performance for fiscal year 2026.
Yeah, the numbers are pretty staggering.
Right. I mean, how do they manage that kind of growth? We're talking revenue jumps that, well, almost defy belief.
Absolutely. So we've looked through their financial reports, the press releases, investor decks, trying to piece together what's really going on.
Exactly. Our mission here is to get beyond just the headline figures, understand the strategy behind this acceleration, and, what it signals for the wider Indian hospitality scene.
It's about unpacking the how and the why, not just the what.
Okay, let's start with the big picture then. The consolidated numbers for Q1 FY26, so that's ending June 30, 2025, total revenue, INR 9.1 billion.
Which is, wait for it, 146% higher than the same quarter last year. Just massive.
Massive. And that flows down right. Total EBITDA, INR 3.7 billion, that's up 150%.
And profit after tax, INR 2 billion. That's a 235% jump.
Wow. And the earnings per share for the quarter was INR 9.30. I mean, these percentages are seriously eye-popping.
Yeah.
But there's a catch, or maybe a key detail, behind these consolidated numbers.
There is, yeah. It's really important context. Those huge consolidated numbers include a very significant new revenue stream hitting the books for the first time this quarter.
Ah, okay. So not purely organic growth across the board driving those triple-digit increases.
Not entirely, no. But, and this is crucial, if you strip out that new part, the residential project revenue, and just look at their core business, hotels and rentals.
Right, the underlying engine.
Exactly. That core revenue was still up a very healthy 27% year over year, hitting INR 4.7 billion.
Okay, 27% is still very strong.
It is. And core EBITDA grew even faster, up 37% to INR 2.1 billion. What's more, their core EBITDA margin actually expanded
Oh, interesting. By how much?
by 3.3 percentage points, reaching 44.4%. So it tells you the fundamental business, the existing operations, they're performing really well and becoming more profitable on their own. Solid organic expansion.
That's a really important distinction. So the core is strong, and then there's this new kicker on top. Okay, let's break it down then. Where did the growth come from, segment by segment?
Right, let's peel back the layers.
First up, the traditional hospitality business, their hotels. Revenue was INR 3.856 billion.
Which is an 18% increase compared to last year's Q1. Pretty solid.
Yeah, and EBITDA grew a bit faster, up 20% to INR 1.608 billion. Margins ticked up slightly to 41.7%.
Okay, so far so good.
But here's the interesting bit. Occupancy was actually down slightly, 66%, which is 4 percentage points lower than last year.
Okay, so fewer rooms filled overall.
Relatively speaking, yes. But this is but the average room rate, the AR, it surged, up 17% year over year to INR 12,207.
Wow, 12,200, that's a hefty rate.
It is. And because of that, the revenue per available room, or RevPAR, still increased. It was up 10% to INR 8,059. So occupancy dipped, but they charged significantly more for the rooms they did fill. What's the story there?
Well, it really points to strong pricing power, doesn't it? It suggests demand is high enough, maybe in specific locations or for specific types of rooms or brands they operate, that they can push rates quite aggressively.
So maybe focusing on higher value guests or segments.
Could be. Or it might reflect renovations, better amenities, maybe corporate travel bouncing back strong in their key markets. But fundamentally, it shows they could more than offset a slight dip in volume with a big increase in price. That's usually a sign of a strong market position or brand appeal.
Makes sense. Okay, let's switch to the rental and annuity business. This is where the numbers get even more dramatic.
Yeah, this segment was on fire. Revenue hit INR 732 million.
Which is up 106% year over year, double the revenue.
And EBITDA, INR 608 million, up 130%. The growth here is just phenomenal.
And the margins are incredible too. EBITDA margin reached 83.1%. That's an expansion of nearly 9 percentage points.
83% margin, that's huge. And it links to the expansion, right? Their total leased area grew by about 50% year on year.
Right, so more space leased out,
Yeah.
generating that recurring income at very high margins. What's driving that? Just more office space demand.
It seems so. Expanding their leasable portfolio, likely in high-demand areas like Powai, is clearly paying off. This provides a really stable, high-margin revenue stream that complements the just cyclical hospitality business. It's a smart diversification.
Okay, and that brings us to the new player this quarter, the big one impacting the consolidated numbers, the residential project in Kormangala, Bengaluru.
Exactly. This was the first time they recognized revenue from it, and it was substantial.
How substantial?
Revenue of INR 4.391 billion, just from that one project in one quarter.
Wow, okay. That explains the huge jump in the consolidated figures
Yeah.
and the profit contribution.
EBITDA from the residential project was INR 1.628 billion, giving it a margin of about 37.1%.
And they mentioned a milestone, handing over flats.
Yeah, 95 flats were handed over to owners during the quarter. So this isn't just future potential, it's actual delivery and revenue recognition happening now.
How significant is adding this whole residential piece to their strategy? Is it just a one-off boost or something more fundamental?
I think it's pretty fundamental. It diversifies their business significantly. Hospitality can be quite cyclical, dependent on travel trends, economic conditions. Adding residential development, even if it's project-based, provides a different kind of revenue stream.
Kind of smooths out the bumps?
Potentially, yes, or at least adds another engine. It positions Chalet less as just a hotel company and more as a diversified real estate developer and operator. That could change how investors view them long term.
Interesting shift. Okay, let's look a bit closer at the hotel operations. Where were people staying? Any regional differences?
Yeah, they break it down. In the Mumbai metropolitan region, MMR occupancy was higher, around 71.9%, but that was actually down 6 percentage points from last year.
Okay, similar trend to the overall number. And ARR.
ARR in MMR was up a solid 10.1%. So again, price offsetting volume dip.
And what about the other segment? That covers Hyderabad, Pune, Bengaluru, etc.
Right. In the other segment, occupancy was lower, 61.1%, and also down slightly by 1.7 points. But the ARR there, it jumped massively,
Yeah.
up 24.2% year over year. So those regions really pushed the pricing.
So it looks like the other segment, despite lower occupancy, really pulled its weight on pricing, even more than Mumbai.
It certainly seems that way. Different market dynamics at play, perhaps.
And what about the type of hotel? Business versus resort?
Good question. Business hotels saw occupancy at about 68.7%. Similar dip to the overall trend, down about 4 points. ARR was up a healthy 13.2%.
Okay, consistent story there. What about resorts?
Now, resorts are fascinating. Occupancy actually increased. It went up by 8.4 percentage points to 45.7%. Still lower than business hotels, but moving in the right direction.
An increase in occupancy and
And the ARR just skyrocketed, up 50.7% year over year to over 17,000 rupees. INR, 17,134.
50% ARR growth. That's huge.
It is, and it means RevPAR for resorts absolutely soared, up nearly 85%.
Wow. So what does that tell us? People are flocking to resorts and willing to pay top dollar.
It strongly suggests that, doesn't it? The leisure travel trend, maybe bleisure, combining business and leisure, seems incredibly strong. People are clearly willing to splurge on resort experiences, maybe post-pandemic pent-up demand, or just a shift in preferences. And Chalet is capturing that value very effectively.
It shows they're adapting, tapping into those changing desires. Okay, so performance is strong, diversification is happening. What about future growth? Are they building more?
Oh, yes. They are definitely not resting on their laurels. They've got a very active development pipeline.
What's just come online?
Recently, they added 121 rooms at the Marriott Whitefield in Bengaluru. That was back in May 2025. And they just finished a big refurb and expansion at the Duke's Retreat in Khandala.
The resort.
Exactly. Added 44 rooms, or keys as they say, plus a banquet hall. That became operational just in July, taking it to 117 keys. And there are another 30 rooms coming online there very soon in Q2, aiming for 147 total.
So upgrading and expanding existing properties. What about brand new stuff?
Plenty of that, too. Under construction right now, they've got the Taj Hotel at Delhi Airport. That's a big one, expected in the first half of FY27.
Okay.
And a beachfront resort in Varka, Goa, slated for FY28. Plus, their second commercial office tower, Enthusiast in Powai, is on track for FY27.
So more hotels, more office space. Anything else further out?
Yes, in the planning stages, they're talking about another 1,200 hotel rooms and almost 1 million square feet of commercial space.
Wow. Where are they planning these?
New hotels planned for Navi Mumbai, North Goa, and even Trivandrum. So they're pushing into new geographies as well. It's a clear strategy of broadening their footprint, both geographically and across asset types.
It really paints a picture of aggressive but seemingly well-planned expansion. Now, all this growth is happening alongside a significant leadership change, isn't it?
That's right. The current MD and CEO, Dr. Sanjay Sethi, is retiring at the end of January 2026.
But it's not a sudden departure.
No, not at all. They've had a successor lined up for a while. Mr. Shritank Singh is set to take over on February 1st, 2026. This has apparently been part of a 2-year succession plan.
2 years. That's quite deliberate.
It really is. It suggests a focus on stability and smooth transitions, which is important during such a high-growth phase. Dr. Sethi will also stay on the board as a non-executive director.
What are the benefits of planning a handover like that so far in advance?
Oh, huge benefits. It minimizes disruption, ensures continuity of strategy, allows for proper knowledge transfer between the outgoing and incoming CEO. It also signals stability to investors, employees, partners. You avoid that uncertainty that can come with abrupt changes.
Especially crucial when you're juggling so many expansion projects.
Exactly. And Dr. Sethi's quote in the release really emphasized the team effort and long-term focus, despite, challenges in the wider environment. He mentioned unwavering commitment to disciplined execution, guest centricity, and long-term value creation. That speaks to the culture they've built.
And that culture seems to extend beyond just operations and leadership, right? They seem very focused on sustainability and being a good employer.
Very much so. They got certified as a great place to work again for the 6th time in a row.
That's quite an achievement.
It is. And their sustainability credentials are, frankly, quite impressive. They have a Dow Jones Sustainability Index score of 67.
So good as that.
That ranks them 6th globally in their sector hotels, resorts, and cruise lines. That's top tier. They also got a B score from CDP for both climate change and water security, which is solid.
So recognized internationally for their efforts.
Yeah, and they're backing it up with concrete commitments. They are apparently the first hospitality company anywhere to join 3 major climate group initiatives: RE100, EP100, and EV100.
Okay, what do those mean in practice?
RE100 is a commitment to 100% renewable electricity by 2030. EP100 is about doubling energy productivity by 2028. And EV100 means transitioning their entire vehicle fleet to electric by 2025.
Wow, those are ambitious targets. Aren't they making progress?
Seems like it. They reported that 60% of their electricity was from renewable sources last fiscal year. All their operational properties have EV charging stations now, and 2 hotels already have 100% EV fleets.
So real action, not just pledges.
Exactly. And their ultimate goal is net zero greenhouse gas emissions by 2040. It really does seem embedded in their strategy, not just a PR exercise. It's about people and planet alongside profit.
Okay, that's commendable. Let's circle back to the financials, specifically stability and risk. How's their debt situation looking with all this expansion?
Well, their net debt as of the end of Q1 was about INR 20.18 billion. But the key metric here is the net debt to equity ratio.
Right, how leveraged are they?
That ratio improved significantly. It was down to 0.65 times at the end of FY25, compared to 1.45 times the year before.
That's a big drop. How did they manage that?
A big part of it was raising capital. They did a QIP qualified institutional placement last fiscal year, raising INR 10 billion.
And use that to pay down debt.
Primarily, yes, and for general corporate purposes. That significantly strengthened their balance sheet. They also issued some secured non-convertible debentures, INR 750 million worth.
Secured, meaning backed by assets.
Exactly. Secured against specific properties, the JW Marriott Sahar Hotel and the adjacent retail space. And importantly, the value of those assets covers the debt plus interest by more than 1.75 times.
So a good safety cushion for the lenders and indicates prudent borrowing.
Precisely. It shows they're managing their growth financing carefully.
Okay, but there is one lingering risk factor mentioned, that legal issue with the Vashi property.
Ah, yes, the 4 Points by Sheraton in Navi Mumbai. That's been ongoing for a while.
What's the situation?
Basically, there was a Bombay High Court ruling back in 2014 ordering demolition related to the land lease. However, the Supreme Court stepped in with a status quo order in 2015, essentially pausing things, and it's been pending there ever since.
So it's in legal limbo.
Pretty much. The key thing, though, is that the company management states they don't expect any material financial loss from it. And crucially, the auditors, while noting the existence of this issue,
They didn't qualify their opinion.
exactly, they did not modify their conclusion on the financial results because of it. This implies that, from an accounting and disclosure perspective, it's considered a known managed risk, and the potential financial impact isn't seen as threatening the overall picture.
The assets involved aren't insignificant, though, about INR 46 million in lease rights and INR 347 million in hotel assets. How does a company keep growing so strongly with something like that hanging over one property?
It speaks to risk management and probably compartmentalization. They likely have strong legal counsel, provisions if needed, though they state no material loss is expected, and crucially, they communicate it transparently. The auditor's stance helps reassure investors that it's being handled within acceptable financial reporting frameworks. It shows they can manage complex legacy issues while focusing on driving the main business forward.
Okay, so putting it all together, Chalet Hotels in Q1 FY26, strong core performance, huge boost from the new residential venture, impressive growth in rentals,
Yeah, combined with strategic expansion in hotels and commercial spaces, a well-managed leadership transition on the horizon.
and a real demonstrable commitment to sustainability and their workforce, all while keeping debt manageable and navigating that specific legal challenge.
It paints a picture of a company that's firing on multiple cylinders, diversifying smartly, and executing well.
Definitely. They seem to have clear direction and are delivering on it.
The ability to juggle traditional hospitality growth with these newer annuity and development-focused businesses is quite striking.
Right. So that leads to a final thought for you, our listener. Considering this dual focus expanding traditional hotels while also growing these newer residential and rental businesses, what new opportunities or maybe even unforeseen challenges might pop up for Chalet Hotels because of this diversified strategy in the next few years? Especially, as India's economy keeps changing and what travelers or tenants want continues to shift.
Yeah. How does that diversification play out long term? Something to ponder.